The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, as we wrapped up the week of the market trade on Friday, for the most part, things were relatively quiet in the grain and livestock trade. Maybe call it a consolidation type day as we wrapped things up and got past the middle of the month of December, technically on the 15th. Well, are we entering into the holiday trading period already? Is it just getting quiet in these markets? That's one of the things that we want to talk about today as we wrap up the week in the markets with Ted Seifried from Zaner Ag Hedge. Ted, always good to catch up with you, buddy. It's been a little while. I know you've been busy with the holidays and traveling and seeing family and all that fun stuff. So glad we could make some time to get back together here on the show. Hope you're doing well.
Yeah, man, I'm doing good. Thanks for having me. I always like to do the show. So yeah, thanks for having me.
Well, I'll start with the obvious question that I kind of alluded to there at the open. It feels like we're kind of entering that holiday malaise across the trade, grains, livestock. We've had plenty of news here this past week, but largely it just feels like a lot of folks are packing it in for the Christmas and New Year's holiday already, Ted.
Yeah, Jesse, it's definitely felt that way towards the end of the week. I think the beginning of the week wasn't so much that way. We certainly had a lot of fireworks on Monday morning with soybeans, up 32 cents, although we've given back really all those gains here the rest of the week. So, I mean, we're still watching South American weather, but really, Brazilian weather that pertains to soybeans. You really don't have anything in Argentina to talk about. And for that Brazilian second season corn crop, at some point, I think I do start to worry about that a little bit because you're talking about replanting soybeans in Mato Grosso right now. A news story out on Reuters about Brazilian farmers having a hard time sourcing, bean seeds to plant or to do replant. To me, that kind of suggests that there's been a whole lot of replant happening. Which spreads that crop out a bit more, which I think maybe puts it in a position to do a lot better than what some people are currently fearing, but also it might push that corn crop back into the sort of danger zone a little bit. So ultimately, I really wouldn't be surprised if Brazilian weather, one, improves, but two, if this story ends up being more of a corn story than a soybean story or it's going to be a bit of both, I think, Jesse. But right now we're 100% focused on soybeans, not really thinking about it in the corn. At some point, I think we'll start thinking about that. But, aside from that, it's the time of year where we kind of, just walk away for the rest of the calendar year, right? So to your point, I mean, it is getting kind of lower volume, kind of quiet. We did have a lot of news this week, both from a individual market fundamental standpoint, export sales. We had 1.3 million metric tons of soybeans sold this week, mostly to China and unknown. And we had export sales, which I think were a bit polarizing earlier in the week as well. The weekly numbers, and then the Fed decision and the big move that we had in the dollar. Stock markets making new all-time highs. Gold up $50 an ounce on Thursday. Crude oil all over the place, so there's a lot going on. But the grains in particular kind of seem anemic, and I am going to say that, you have some chart setups, kind of polarizing as well. You look at the wheat and we've had a nice bounce off the lows. We pulled back off that, kind of setting up with a little bit of a potential bull flag scenario on the wheat chart right now. But then you have soybeans that continue to test, key moving average support, 200-day moving average support. And each time we get there, the bounce is a little bit feebler, so that is a concern, both from a price action standpoint and also just a chart standpoint. So I don't know. Holiday timeframes could be kind of weird, especially when you got weather markets. I think it's going to be a little bit weird for the next couple weeks.
Yeah, that's a good way to put it. No, I'm in agreement with you there. A few different news headlines. You mentioned in soybeans. Talking soybeans there. Argentina looking to devalue their peso earlier in the week. That seemed like that had a bit of a psychological impact on the market per se. I wonder your thoughts on that situation. How much of an impact could we really see that have in soybeans here in the short term, Ted?
What was it Tuesday, Jesse? We were higher because they closed their export portal
Yeah.
or registrations, right? So there
Yeah.
was a few days there where they couldn't export, and the language was, until further notice. So I mean, I guess to some extent the market was worried that could last for a little while. I don't know. At the time, I remember saying, by Friday they'll be back and exporting again, and they are. So yeah, that was a 1 day blip. But then the reality is when they devalued the currency, but then they also pegged it to the dollar, and that's the key, Jesse, because the problem with Argentina is that their currency had been kind of devaluating itself, over and over and over again. So Argentinian farmers wanted to hold on to physical commodities because it was their hedge against their currency inflation. But if you peg their currency to the dollar, which they've done now, and you have a more stable peso, the question is, do these farmers really feel like they need to hedge against inflation now? And the answer to that's probably not, very likely not. So I think there's a fair amount of wheat. Nobody's really been talking about this with wheat, and it's because they've got a really not great wheat crop. But the year before they had a good one. I think there's a fair amount of wheat in storage that could come out. That again, they were holding these commodities, soybeans, corn, wheat, to hedge against the inflation, which again they don't really need to do anymore because of the new plan or the new currency plan, I guess. So there can be a lot of ending stocks. Perennially, Argentina holds 10 million metric tons of soybeans, generally speaking, year over year, as again an inflation hedge. They might not need that anymore. So again, these are stocks that can come onto the market. In the case of soybeans, it likely goes to the crush, and it's good timing for that because of last year's soybean crop not being good at all. They could use those beans, so that alleviates some problem right there. I think that might alleviate some of the or might take away some of our extra soybean meal exports over time. So that is a bit of a concern. But yeah, generally speaking, it's, I think, a fairly bearish thing for the market. It was a little bit bullish in the short run because of that export registration window closing. But now that it's open again, yeah, further on down the line, I think that's going to be fairly bearish.
I know on Friday, the U.S. Treasury Department came out with their guidance saying they were going to adopt the GREET model as one of the methodologies in terms of figuring out the sustainable aviation fuel tax credits. I know a lot of folks in the ethanol biofuel industry, the ag industry as a whole, celebrating that news, looking for, to use corn as a feedstock for sustainable aviation fuel, et cetera. Largely, though, the corn market just kind of looked at the news and went on about its day. Your thoughts on that news from Friday, Ted?
I think long run, that is fairly bullish, right? Look, we need new avenues of demand for corn. And this is another one, right? Because I mean, if we keep planting 90 plus million acres of corn, we don't have enough ethanol demand. We're not driving enough, Jesse. We don't have enough feed demand. We need to have more corn demand to avoid these 2 billion bushel plus carryovers. So that's good news. Now, the thing is, I don't really see that having a massive impact for this marketing year, which is why I think the corn market's kind of shrugged that off. It's going to take some time for that demand to really develop. I mean, there's infrastructure that needs to be put in place and things like that. So I think it's great. I think it's great longer term. I'm a little worried that it cuts into some soybean oil demand, but I think there's room for both to really grow again over time, right? So that's kind of why I think there was just really not much of a reaction there for corn. It's good to see guys like myself and producers. We welcome that. It's great, but again, it's not we're not taking our 2.15 a billion bushel carryover in corn and slashing that to a 1.6 just because of that announcement. That's not the case at all, right? But it will hopefully mean good things for next year, and even more so for the following year, and even more so for the following year, right? So it's a thing that I think longer term is a very nice thing for the corn market. It will be a good thing for prices. I think it adds more to the floor of corn, right? But again, it's not a this year thing. At least, that's not my take on it.
We are having a conversation today with Ted Seifert from Zaner Ag Hedge joining us here on Market Talk. Ted, I want to spend some time with you on the Fed news that we had from this week as well. And I believe it was the New York Fed chair on Friday kind of came out and said, hang on a second, we're not necessarily saying that, we're going to have rate cuts starting early next year. It was something to that effect. I think I saw that news item come out Friday morning, but just talk about your thoughts on some of the guidance that we saw from the Fed. I know there's been talk about their dot plot and things like that. What's your take on all the Fed news and where we stand near the end of the year, Ted?
Well, we got a profound reaction from the Fed, the result of the Fed meeting, right? They left rates unchanged. That wasn't the reaction, right? That's not where the market reaction came from. It came from Jerome Powell's statements afterwards saying that there could be 3 to 4 rate reductions in 2024. And that is a pivot from kind of what they had been saying earlier. It seemed a lot more of an aggressive stance as far as lowering rates. And the dollar was down sharply for 2 days, and stocks were higher. Risk on commodities across the board, as we mentioned earlier. The gold, for example, up $50 an ounce. Crude oil up $3 a barrel. But here's the thing, Jesse. I get the feeling that in recent years, the Fed has realized that sometimes, actually a lot of times, their language works better than their actual actions. And I think that was really what that was all about. I think that they wanted to leave rates unchanged. And if they didn't change their language, that would have been fairly actually bearish for a lot of these markets. But by changing their language, that kind of glossed over the unchanged rate, and it really put a lot of optimism in the markets and a lot of risk on for the markets. So I don't know. They say one thing. I'm not 100% sure they're going to do that. In fact, personally, I don't really see more than 1 or 2 rate cuts next year. I think they have to be very careful with doing that. And yes, while we have rates at the highest level that we've had in 22 years, they're not terribly high. They're not like what they were in the 80s. I think they are fairly sustainable. And after all of the stimulus that's been dumped into the markets via COVID, via Ukraine, via, just really all the stimulus packages that we've seen, I think we are due or sort of need a longer period of higher rates. Now, as a consumer, as anybody that's looking to buy a house or buy a car, or, anything that has anything to do with paying interest, you don't love that, right? But as an economist, right, you think that, hey, maybe this is a good thing for our country as a whole, maybe the global economy for that matter. I don't think they should be cutting rates that aggressively next year. And again, I think this is a case where they use their words to get the reaction that they wanted. I'm not 100% sure they'll use their actions in the way that they had said.
Well, of course, thinking about inflation and interest rates, et cetera. I mean, you think about interest costs for farmers storing grain this fall. You think about the cost of if they're looking at land or equipment purchases or any conversation with their banker. You think about the livestock side, the impacts of just the overall economy on some of that retail demand and more. I mean, there's a lot that ties in with what's going on with this broader economy in terms of the ag economy, but also too, Ted, your thoughts on this? I know the ag economy is a little bit more insulated currently from the overall economy to some degree, just because there is still a decent amount of capital that's sitting out there in some farmers' bank accounts, Ted.
Yeah, absolutely. I mean, we've had multiple years of really good prices. This isn't 2012 where we had one really good year and a lot of us didn't really have much of a crop. We've had multiple years of prices at the higher end of the spectrum, not record high prices, but at points not far off. And, we've had fairly decent crops. Again, look, you got to generalize when you're talking about the country as a whole or, whatever. I know some of us had, disasters, and I feel bad, of course we all do. But as a whole, yeah, we've enjoyed high prices for a long period of time. And at the same time, we had very low interest rates. And so, yeah, right. There was a lot of income coming in. And let's be honest, Jesse, as much as it's an unpopular thing to say, we're still sitting at some really pretty decent prices historically, right? I mean, look at March 2025 corn trading 520 plus. Hey, that's really good. We went through years, Jesse, where I would have guys asking me, are we ever going to see $5 again? Okay, well, I mean, obviously we did, and then we saw 6 and we even saw 7, and that's great. And that changes the mentality. Now guys are worried, 5's not enough. And again, I mean, the climate's changed, and yeah, with input costs had been super high, and now with interest rates, and yeah, I mean, things have changed. So, maybe you do wish you had $6 corn, obviously, but 520 March corn, I still think that's a really good opportunity, because I'm really worried that we're swinging the pendulum to the other side of the spectrum, Jesse. We can and probably will go through years of, like we were in 2018, for example. We're overproducing. We can't find new demand. We're not getting new demand at really low prices. The function of the market's not really working, so on and so forth. Unfortunately, that's kind of how this works. We go from one extreme, and we spend a lot of time at the high end of the extreme, to the other extreme. And over the course of the next couple of years, really, I think the only thing that can really save us from something like that happening is multiple crop disasters again. But at some point, weather's just going to get it right, and again, we'll be sitting at big carryovers. Like the outlook for corn's already there, right? It's just not there for soybeans yet. And I also want to caution guys, go back to 2013. We had a really tight balance sheet in 2013 for soybeans. In fact, it was tighter in 2013-14 than it was in 12-13. But prices were on the decline throughout that year, partially because of the macroeconomics of everything, but also because the corn carryover jumped back up because we planted a whole bunch of corn acres. It's actually a very eerily similar situation to what we had with last year's growing season. And again, with our current projected balance sheets, where we have a 2.1 billion bushel plus carryover in corn, and a 240 million bushel carryover in soybeans, which is relatively tight, and soybean prices have stayed relatively strong. But my point with all of that, Jesse, is that doesn't necessarily have to be that way. You can see soybean prices coming down even with a relatively tight carryover. In fact, I think that's kind of a lot of what's going on right now with, there's a lot of bulls in the market screaming about South American weather, Brazilian production coming down 10 million metric tons. And there's so many bullish factors in the market. China buying, like we said, China an unknown for 1.3 million metric tons. Is a situation where we're throwing bullish news at the market and it's not really responding. We're lower for the week after the big update that we had Monday. It's a warning sign for me, Jesse. I think that's a red flag, and I think we all need to take note of that. And rather than just kind of walk away from now to the end of the calendar year, I think guys should be really looking very hard at some risk management strategies. Because I say it all the time. Between the end of December and the first week of January, that's usually our second highest peak of the year. So if you get 35 to 45. And this year, I think, is an important time because it might be the highest peak of this marketing year. I think if you get 35 to 45 to even 50% new crop sold, I think you're sitting pretty well, right? And you can always use really inexpensive calls to re-own those if you want to. I know that's a very polarizing thing. Some analysts hate that. Some producers hate that. Others love it. I'm pretty indifferent. I really do think it's a very viable tool for guys that are worried about selling because they're worried about missing out on opportunity. Well, if that's the case, hey, re-own that opportunity. It's a lot cheaper to risk 9 cents on a call than risk $1 on flat price. So if that helps you, by all means, let's do it. If you're super against it, okay, that's fine too. You're always gonna have more corn to sell. Same with beans, So either way, there's a lot of different strategies. I think again, don't be sleeping on it right now. And by the way, for corn, the highest point that we had for a long period of time was January 1st for corn. The only reason we went and beat that, and only barely, it was because we had not rain from April all the way into June, right? And we had that big, $1.40 rally in June, and then we gave it all back. And you had a very, very brief period of time to sell corn at a higher level than it was on January 1st. But again, very brief. And most guys didn't because they weren't sure if they're going to have a crop at that point. So it's a lot easier to make marketing decisions in December if you're still paying attention. Don't just walk away. That's my message here, Jesse.
I think that's a great message for us to wrap up on, Ted. If folks have questions for you and they want to talk to you about some things here, it's that time of year where I know a lot of folks could be looking at the books and thinking about their marketing plans and more. How can they get a hold of you there at Zaner Ag Hedge, Ted?
Yeah, absolutely. You can reach me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner.com. And you can find me on the the X, whatever. I'm at the Ted Spread.
Ted, always appreciate a conversation. Thanks so much for joining me, my friend. Have a Merry Christmas, a Happy New Year. We'll talk to you again soon.
Thanks, Jesse. You too, man. It's always a pleasure to be on. So thanks for having me, and you have a wonderful, happy holiday season as well.
Ted Seifert with Zaner Ag Hedge joining us here today on Market Talk. That's going to do it for the show. Find us online at markettalkag.com. I'm Jesse Allen. Have a great weekend.